Hey guys, it's Aman
and Christina
from Our Rich Journey. Today we are talking about bonds, and everything you need to know about investing in them for financial independence. If you are building an investment portfolio, you have had to ask this question: how much percent of bonds should you have in that portfolio?
So like Aman said, whenever an investor is creating their investment portfolio, they need to decide on asset allocation, specifically between stocks and bonds. So are you going to invest 50% stocks, 50% bonds? Are you going to do 100% bonds, 100% stocks, or anything in between? These are things you have to think about when you're developing your investment portfolio. So in this video, we want to talk about bonds to help you make that decision. So we're gonna go over bonds in general. We're gonna show you where and how to buy them. We're gonna talk about some of the specific bonds that we think you should look into if you're interested in investing in bonds. And then we also wanna talk about what we think about investing in bonds for financial independence. So let's first start off with the basics and talking about what bonds are. So governments and companies issue bonds because they need to borrow money. So they issue these bonds and investors purchase them. It's almost like an IOU. So you're basically, when you invest in a bond, you are loaning a company or government money.
So like Christina said, bonds are like IOUs, and you can buy them in a number of different ways, which we'll get into. But basically, when you buy a bond, you are loaning that money to the government or to a company for a certain period of time. And in exchange, while they use your money to do whatever they're gonna do with it, they pay you interest on that money. So for example, let's say you buy a 10-year bond for $5,000. And let's say that bond pays you 2.5% interest. In exchange, the bond issuer, say it's a local government, will promise to pay you interest on that $5,000. So you'll get 2.5 interest on that $5,000 for 10 years. And at the end of those 10 years, which is when the bond reaches maturity, you get your $5,000 back. Now there are three common types of bonds that you can buy. Let's talk about the first most common type, and those are corporate bonds. These are bonds issued by corporations like Ford, Coca-Cola, and Apple. Whenever they want to raise money or borrow money, they can put out bonds. But not all bonds are created equal. There are investment-grade corporate bonds and high-yield corporate bonds.
So let's start off with the investment grade corporate bonds. Now these types of bonds are issued by companies with good to excellent credit ratings. And because of their really good to excellent credit ratings, they are seen as safe borrowers. And because of this, the bonds that they issue tend to have lower interest rates. Now let's compare this to high yield bonds, which were also formerly called junk bonds. Now these type of bonds are issued by companies with poorer credit ratings. And because they have these poorer credit ratings, they need to entice investors to loan them money or to invest in their bonds. And they do this by issuing bonds with higher interest rates.
Now this to me is very fascinating because you can have a corporation that has investment grade corporate bonds. They are an excellent corporation, and so your return on your investment when you buy their bonds is going to be much less. But if you want to be risky, then you can go after those junk bonds or high yielding bonds, and the return on those is going to be significant, but you have a higher chance of default with those types of bonds.
So let's talk about the second type of common bond, which is the municipal bond, which is often also referred to as munis. So these type of bonds are issued by local governments like the state or even a city or a town, and they use this money in order to generate money for special projects or services offered through that local government.
Now don't be fooled into thinking that because you're investing in a municipal bond that it is a safe bond. Municipalities like cities and states and counties, they also have credit ratings because they manage money, and sometimes they don't manage their money well. And when they don't manage their money well, they don't pay their bills, which includes payments to their bondholders. So be very careful when you're selecting bonds by municipalities.
So let's talk about the third common type of bond, and those are the federal government bonds. So unlike corporate bonds and unlike those municipal bonds, the federal government bonds, these are the safest. They are backed by the full faith and credit of the United States, but because of this, because of their high safety rating, they have very low interest rates, and they tend to have the lowest interest rates out of those three types of bonds. So now that we've gone through the three different common types of bonds, let's go over the common ways that you can buy them. So the first way that you can buy them is through a broker when you're buying individual bonds. And you can buy primary issue bonds or secondary issue bonds. Now, primary issue bonds means that you're buying the bond and the money is going directly to the company or to the government. But when you're buying a secondary issue bond, it means that you are purchasing a bond held by another investor. So you can buy these types of individual bonds, primary and secondary issue, from an online brokerage company. And there's also those low cost online brokerage companies that sell them, like Vanguard, Schwab, and Fidelity.
Now, the second way to purchase bonds is also through a broker, but instead of buying individual bonds, you can buy a basket of bonds in an ETF or an index fund or a mutual fund. And this is a way that we're going to talk about in more detail later on in this video, but this is just another way to also buy bonds. And the third most common way is directly from the US government. And this was the way I first started buying bonds back when I was knee-high to a grasshopper, I was buying bonds directly from the federal government. In fact, this is how most of our parents bought bonds. They would get them as a little piece of paper and they would give them to you as a Christmas gift or a birthday gift. These were government issued bonds. And this is a great way to buy federal government bonds directly from the Treasury, because by doing this, you're avoiding commissions and expenses that a regular brokerage might charge. So that's all of the preliminary information when it comes to investing in bonds. Now what we want to talk about are our picks for bonds. Now, you know that if you've been watching our channel for long enough, we talk a lot about index funds. We love the diversification and the stability that index funds provide when you invest in them. And just like when you're investing in the stock market with an index fund, we also think you can invest in the bond market with an index fund. So what we're gonna do next is we are gonna go to the three brokerages that we like the most: Vanguard, Fidelity, and Schwab. And at each one of those brokerages, we are gonna identify bond funds that if you are interested in investing in bonds, you should consider these funds.
So let's go over the first bond index fund with Vanguard, because we love Vanguard. So the index fund with Vanguard is the Vanguard Total Bond Market Index Fund Admiral Shares. It's VBTLX. So the expense ratio for this fund is 0.05, and there's a minimum requirement of $3,000 to invest in this particular index fund, which means that if you want to get started investing in this fund, you need to start with at least $3,000. Now, one of the nice things about bonds is that they pay interest. So when you're investing in bonds, one of the things you want to pay attention to is the coupon payment of a bond or a bond fund. So the coupon payment is the annual interest payment that you would receive by investing in the bond. And in this case, the average coupon, which is the average annual interest rate that you would be paid with VBTLX, is 3.2%. So in other words, every year that you own the fund, you would collect an average of 3.2% in interest payments each year. So this bond holds more than 9,000 bonds, which is really good because by holding so many bonds, if any one of those bonds in the fund fails, its impact would basically be minuscule.
So let's just marinate on this for 1 second. This is the power of investing in index funds. And this is why we are huge proponents of this. Because when you invest in an index fund, you are investing in a basket of stocks, and in this case, bonds. And let's say one of these bonds goes into default. It doesn't mean that you lose all your money. You just lose the tiny minuscule percent that that one bond that fell had in this whole group of other bonds. This is why we are not recommending investing in individual bonds, but instead in a basket of bonds through index funds.
So if you're interested in investing in the Vanguard Index Fund, like I said, it is a $3,000 minimum in order to invest in this particular index fund. But Vanguard also has an exchange traded fund, an ETF equivalent to the index fund. And so it doesn't have that $3,000 minimum requirement. You just have to purchase the one share of the ETF, which is currently less than $100, and that ETF is BND.
So let's go to our second favorite brokerage in the world, Fidelity. Actually, we love them all the same. Fidelity has a total bond fund, which is called FXNAX. That is a mouthful. The expense ratio is 0.025%, and the minimum to invest is $0. There is no minimum. The average coupon is 3.05%, which is slightly lower than Vanguard. Like Vanguard, this index fund holds more than 9,000 bonds.
And finally, there is the Schwab Index Fund. It's called the Schwab US Aggregate Bond Index Fund, SWAGX. Now, its expense ratio is 0.04%, and there is no minimum requirement to invest in this particular index fund. So its average coupon is 3.12%, and it holds a little more than 6,700 bonds. So it has less bonds than the bonds in the Fidelity and Vanguard index funds, but it also still has enough bonds to create good diversification.
So if you're interested in investing in bonds, take a look at these index funds and do your own research. We think index fund investing, even with bonds, is the way to go. But of course, that is just our opinion. What we want to talk about next is our opinion on whether or not investing in bonds for financial independence is the right thing for us to do. And I'll just let you know right now, we don't invest in bonds. And we feel very strong about this because when we devised our financial independence plan, we chose not to invest in bonds for very specific reasons.
Now, don't get us wrong, investing in bonds does have pros. It provides fixed income, it provides diversification for a portfolio, it provides less risk to a portfolio, but in general, the biggest reason as to why we don't invest in bonds is because bonds are not as aggressive as stock investments, and they don't produce the same type of return that we can get on a portfolio when we're investing in 100% stocks.
Now, some of you are probably blown away by that. You're like, all you invest in is stocks? That is what makes up your portfolio? You gotta have bonds. Everyone says invest in bonds. Well, what we're gonna show you next is why we approach investing in the stock market in this particular fashion. And remember, you must have a plan when you invest, and that plan should be researched.
So for us, we're always trying to research and really trying to figure out the perfect allocation for our portfolio. So we looked at tons of different studies. We looked at tons of different information about past performance. So one study that we want to point out that's very recent is a Vanguard study that looks at asset allocation between stocks and bonds. So take a look at the Vanguard study on the screen. It shows the performance of different portfolios with different asset allocations between stocks and bonds. And it looks at the historical returns of those different portfolios from 1926 to 2018. So if you look at a portfolio that's 100% invested in bonds from 1926 to 2018, it would have produced an average annual return of 5.3%. But if you look at a portfolio that's 100% invested in stocks from that same time period, it would have produced an average annual return of 10.1%. But as this portfolio gradually adds bonds, the average annual return also gradually declines, meaning that historically, bonds have decreased the annual average return of the portfolios.
So in other words, when you add bonds to a portfolio, bonds act as a drag on that portfolio. They reduce the return on your investment.
Now, one thing I do want to point out is that emotion plays a very significant role in an investor's success. So with Aman and I, we are very comfortable in the volatility of the stock market. We do not panic sell. We stay with our plan and we continue to invest according to our plan. But if you are a panic seller or if you are worried about the volatility of the stock market, then bond investing may be for you.
And that is a very key point. Yes, this study shows that over that long period of time, you got a 10% return. That's only if you stayed the course, because over that period of time, there were probably huge swings in the market, and someone that can't stomach those swings was probably selling low and buying high. And by doing that, their return was probably significantly less than 10%. On the other hand, the person that had bonds in their portfolio, they probably didn't see those same type of market swings or paper losses. Instead, they saw short, small gyrations in the market. And for them, maybe that was a little better for their investment journey. You see, emotions is a big part of investing. We think it is the number one factor that separates good investors from really bad investors. So if you are going to invest, make sure that you take into account your emotions and you pick an allocation that takes that into consideration.
So now that you know we are 100% invested in stocks and 0% invested in bonds, it's because we have our own unique plan, and you should be investing with your unique plan in place as well. And this is why we really made this video, because we wanted you to know and understand how bonds work and understand whether they would be helpful for your own unique portfolio as well. So remember, if you like this video, give us a thumbs up, subscribe to this channel, and join the journey.